Bloomberg is hosting a state and municipal finance briefing here in New York today. As deficits begin to narrow, the conference asked how municipalities may be affected by huge budget cuts being proposed by state governments. Pennsylvania's former governor Ed Rendell weighed in on what he says are myths surrounding these deficits.
Two myths that are out there right now. Myth number one, that collective bargaining is the reason for the state's deficits. It's the recession and the loss of the stimulus money. Proof, Texas has been a right-to-work state forever. It has the largest deficit in percentage of overall revenue of any state in the union. If collective bargaining was the problem, Texas would be sitting pretty, folks. That's number one. Myth number two, which the Governor Walker's et al. Are trying to propagate, is that collective bargaining, the unions always win. The public employee unions always win. Ludicrous.
Renowned analyst Meredith Whitney was also a main topic of today's discussion, specifically predictions she made last year calling for massive defaults in the muni bond market. She said back in December, quoting here, "There's not a doubt in my mind that you will see a spate of municipal bond defaults." Whitney said she expected hundreds of billions in defaults that led investors to pull about $4 billion from municipal bond mutual funds over the next month. Thomas Metzold of Eaton Vance Management was one of the panelists slamming Whitney's remarks today.
Mathematically, you couldn't even have had hundreds of billions of dollars given the parameters she set forth, which was states wouldn't default, revenue bonds wouldn't default. There's not even $200 billion of other bonds out there. So I think she's been debunked, and I hope that people will realize that and return to the market.
Now let's bring in another person who's taking part in today's conference. John Miller, Chief Investment Officer at Nuveen Asset Management. He manages the Nuveen High Yield Municipal Bond Fund, which has over $4 billion in assets. He's also co-head of Nuveen Asset Management, which manages more than $90 billion of municipal fixed income. Mr. Miller, welcome to Bottom Line. Thanks for coming on. Thanks for participating in today's event.
Thank you for having me.
Is Meredith Whitney right?
Well, I think that the prediction of 100 to 200 billion in defaults is not going to come to fruition.
Why
not? First of all, they're secured by very significant revenue streams, and throughout this whole budgetary crisis, debt service has really not been the crux of the problem. Labor costs, other expenditures that are rising in an environment where revenues had fallen, that has created some budgetary imbalances, which are in the process of getting closed.
So is there a cause for concern, but perhaps not as much concern as we've been hearing?
The concerns, I think, should not be related to defaults specifically. Now, there are concerns related to potential ratings downgrades. There are concerns around liquidity and mutual fund inflows and outflows. Lately, there have been more outflows, and that can affect valuation, but it's really not being driven by defaults, which are actually running very, very low.
Well, let's talk about psychology, because Iris Lav of the Center on Budget and Public Priorities had an op-ed in Sunday's New York Times. She wrote that talk of defaults by state and local governments, quote, hurts those governments in the long run by undermining investor confidence and raising their borrowing costs. She added that the confusion is rooted in a failure to distinguish between cyclical budget problems and the longer-term soundness of state and local borrowing. And she said there's some other things that can be done to address them. How does this affect the psychology when we hear this back and forth between an Iris Lav and a Meredith Whitney?
Sure. Well, I agree with what Ms. Lavin had said in your quote. The municipal bond market is very diverse, and actually it can be very confusing. I agree this is more of a cyclical problem, and that has affected confidence. The negative commentaries have affected confidence, but the cycle is turning up, and municipal credit does benefit from an upturn in the economic cycle. It just does so with a lag, and it does so in a more political environment.
What type of lag are we talking about?
Well, we already saw about a 6% to 7% increase in municipal revenues in 2010. Now, they're coming off of a recession low that was below where they had been receiving revenues in the 07 to 08 period.
And we should mention that muni issuance down about 40% so far this year.
Municipalities municipalities are not issuing a lot of debt. And I think austerity is more the mindset in state governors' offices. State legislatures are focused really on debt reduction, narrowing the budgetary gaps if they do exist, to some extent raising taxes and cutting spending to narrow these gaps. But they are actually doing that.
Is the municipal bond insurance industry ever going to bounce back?
It's a very, very long-term possibility. It's not likely to be a very significant force in the municipal bond market
Why is it
this year.
falling off so much?
Well, it was primarily due to the credit ratings downgrades, which themselves, those credit ratings downgrades were due to blow-ups in the real estate portfolios, CDOs, CDO portfolios that big companies like MBIA and AMBAC had also used their guarantee on CDOs. Those experienced significant losses and downgraded their credits. If you have a downgraded credit on an insurance facility or wrap, that wrap becomes not very valuable.
What's been driving capital out of the market? Is it concerns about a muni bond bubble?
I think it's really a combination of fear of defaults, negative headline risk about projected budgetary gaps, which, as we mentioned, governors and legislatures are trying to close those gaps. To some extent, that may be also driven by fear of interest rate increases and redeploying capital into the stock market. So all of those factors have driven flows out of the funds.
At the Bloomberg event today, Dan Sullender, Director of Municipal Bond Management at Lord Abbett & Company, he said that state and local asset sales aren't sustainable solutions to plug budget holes because they're a short-term solution to a long-term problem. What's the long-term solution?
Well, the long-term solution is to have a revenue stream that is consistent with your annual budgetary expenditures and to rebuild rainy day funds. Now, debt issuances actually increase your annual expenses because of the increased debt service that they are going to require, and they, in many instances, push, say, a current year deficit into subsequent years or following years. So that's why I agree that that's not a long-term solution. The solution is really to get the expenditures in line with the revenues.
Where are the states and cities going to get the funds they need for capital projects at this time?
Well, that's a tough question. If they're not going to be issuing a lot of debt, if they feel that they have tapped out on the tax increases that they have already implemented, I think one potential solution could be a re-extension of Build America bonds, which is being discussed, but is not yet come to fruition.
That hasn't picked up steam yet, has it?
There's more talk about it, but I don't. It's hard to gauge the momentum. It's probably below 50-50.
Are things going to be worse next year when some of those federal stimulus funds run out that some of the municipalities, some of the states were using to balance their budgets?
We're in the midst of those funds rolling off right now. And they're probably going to be pretty well deployed and spent by mid-year this year. So in fact, if state governments, broadly speaking, can have their budgets in balance, in a realistic balance by June 30th this year, that would be for the forecasted fiscal year of 2012, would be mid-year this year. If those are in balance, then I think 2012 could actually be quite favorable.
How are investors playing the market right now? What should they be looking at?
Well, right now what they are doing, what they have been doing over the last 5 months is they've been focused very much on short-term high quality. So the money that's being deployed in the municipal market right now tends to be 7 years in maturity and shorter, and it tends to be AA and higher. Now, what that has done is left lacking in demand those securities longer out, 12, 15 years. It's lacking in demand for BBB rated securities, and there are opportunities there, albeit higher volatility, but also much higher yields.
Last 30 seconds. Senator John Kerry of Massachusetts, he's proposed the creation of a national infrastructure bank. Good idea in these times?
I think that has some merit. Certainly, the details, the devil will be in the details. But I think that as these budgets get narrowed and spending cuts can be painful to specific communities, focusing on our national infrastructure is a very important priority, and we wouldn't want to see the U.S. get left behind on that front. All
right, John Miller, Nuveen Asset Management, taking part in our Bloomberg Link briefing today, state and municipal finances. John, thanks so much. Pleasure to meet you.
Thank you very much.
Appreciate it.
Thanks for having me.